The only thing I love more than my mother and my gumdrop buttons is subscriber questions, which we got from Fusion, who said, I'm not seeking financial advice, but I would like to see a video about the negative side of dividend investing, taxes. Is it wise to open a self-directed Roth in addition to a taxable dividend account? The answer is coming up, so stick around. Hey, what's up? I'm Russ, and this is Dapper Dividends, where we are working to make work optional, and we're doing this through stock and crypto passive income. The first and biggest negative that I see are taxes to a dividend growth investor if those taxes are in a taxable brokerage account. If they're in a tax deferred account, then you're going to pay them later. If it's a traditional or if it's a Roth, then you're never going to pay taxes on those. When Warren Buffett took over Berkshire Hathaway way back in the day, he stopped paying the dividends. He stopped paying the dividends because he wanted to retain 100% of the earnings so they could acquire other businesses with a durable competitive advantage, and also they could buy back shares. Warren Buffett and many other investors are preferential to stock buybacks because they don't create a taxable event for the investors. Obviously, this was back in the day before everybody had the IRAs, but it stands to reason nowadays that if you have a taxable account, then you're going to be paying income on those dividends. But when stocks appreciate in price, which is what buying shares back does, there's less shares, so the earnings per share goes up. And as the market reacts to earnings per share continually going up, then the share price goes up as well. That's capital appreciation. And when there's capital appreciation, we're not paying taxes on that until you sell. And if you never sell, then you're never paying any taxes on those stocks. And speaking of taxes, there's 3 tax brackets for the dividend income. You're either going to pay 0%, 15%, or 20%. And as the table shows, if you're single, you will pay 0% on that dividend income up to $40,000. And married, you will pay nothing on up to $80,000. The second negative that I see is drip investing. When you drip invest, you are buying shares at low, medium, high, all over the place, but you are guaranteed to buy at all-time highs. Now, I've been buying Pepsi at all-time highs because I'm buying that 1 share a week until I reach 100. Kind of an experiment for me in getting used to buying quality when it is up there. Now, that's again against what Warren Buffett does. He likes to buy things that are at a steep discount, and Pepsi is probably slightly overvalued now, but I'm buying for the long term. We are buying to hold for decades. And I think in a decade or two, what I'm buying at what are all-time highs now will look pretty cheap in that time. So again, that's really more of a short-term problem, but I do like to not drip. I like to collect the dividends, cut it with new cash, and then strategically reinvest those dividends into companies that I think are potentially undervalued. Third, if you're a hands-off investor, which many people are, if you don't have the time to do the due diligence, then I strongly recommend a total market ETF, much like the VTSAX or VTI, or something even like the SPY, just something like that. But when you see ETF, remember that you're going to be paying an expense ratio because some company somewhere, they don't run these funds out of the goodness of their heart, so we have to pay them for that service. And just to show you, the iShares Core S&P Total US Stock Market ETF has a expense ratio of 0.03%, but the iShares Select Dividend ETF has an expense ratio of 0.39%, making it 13 times more expensive in expense ratios. And always remember, expense ratios will cut into your income. Fourth, this is going to affect mostly young investors, newer investors who are all about that income and they want biggest bang for their buck. So they're going after the sky high yields. A lot of REITs suck people in, suck investors in with 13, 14% yields, and that's just not sustainable. So I always say, if you see a yield that's sky high, 9, 10, 11%, and a share price that's maybe $20, $30 and under, big red flag. Do a lot of due diligence on that. And my advice to that would be to stop buying the dividend and start buying the business. Remember, buy a solid business that has a lot of earnings, a lot of cash flow, that's growing their earnings, growing their sales. You'll be just fine. And stop picking stocks and start analyzing businesses. Stop picking yields and investing in yields. Do the fundamentals, which is the business aspect. Start analyzing the business, and just do not, please don't just buy a dividend yield. So what would I do? I would max out the retirement accounts that your work has, especially if there's any match. That's free money. Take it up to the match. You have to do that. Talk to your HR department if you don't know or you're not sure. Secondly, I would open up also, if you're able to max out, if you're in a position and you're able to max out your IRA, which is up to $19,500 for most of us here in the United States, then I would open up a Roth IRA, because that is just something that's fantastic, that you're never going to have to pay taxes on that money again, especially if you're in a much lower tax bracket. We want that money to grow and never have to pay taxes on it again. And always remember, with the Roth IRA, you can pull out your contribution. You can contribute currently up to $6,000 a year. If you put in $6,000 and in 2 years you have $8,000, you can pull that $6,000 or $6,000 worth back out anytime. And once you've done all that, then I would put the overflow into a taxable brokerage account to use as a bridge account to pay bills until you reach 59 and a half. I'm in the FIRE community. A lot of us want to retire early, which doesn't mean we're going to sit around doing nothing. It means that we're going to do what we want to do, when instead of doing what we have to do. Work will be optional. That is the goal. That's the message that I preach on the channel, is that I am working to make work optional. And I've been doing what I'm doing, working in the commercial loading dock industry for almost 22 years now. I enjoy it. I like to get my hands dirty. I like to turn wrenches and do welding and fix things and see the product of my work firsthand, stand back and say, yeah, that looks good. And, well, not like that, but that's what I like to do. And will I still do this once work is optional? Don't know, but this is what we're doing. Work optional is doing what you want to do instead of doing what you have to do. And my last little bit of advice is to always put REITs inside of a tax advantaged account, because almost every REIT that I'm aware of, their dividends are not qualified, meaning that you will pay your ordinary income tax rate on them. So if you can, we want to hold REITs inside of tax advantaged accounts where we're not having to pay our ordinary income tax rate, not getting that special dividend income tax break. While you're here, let me know what some of your favorite dividend growth investing tips are, or why you don't dividend growth invest. And while you're at it, and we're speaking of great companies, check out this video right here on Clorox, and I will talk to you there.